Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes, about 6 minutes to go before the closing bell. And it's time for the big picture as we head into the end of the trading day. Let's welcome in Michelle Gibley, Director of International Research at Charles Schwab. Michelle, thanks so much for joining us to close out the trading day.
Hello, Caroline.
So we've had a very U.S.-focused show here today. A lot of talk about the inflation print this morning, the core PCE, which of course is the Fed's preferred inflation gauge. But when you zoom out and look at the rest of the world, what's the inflation picture looking like around the world?
Yeah, inflation is sticky, and that's a global phenomenon right now. In developed markets, it's really stopped moderating. It's either leveled off or increased recently. Friday, we'll get CPI updates from both the Eurozone and Japan. In Japan, we get the Tokyo reading. That's the leading indicator for the national figure that comes out 3 weeks later. And among the factors limiting the decline in inflation globally is services, and that's because of higher wage growth. Now, the increase in inflation recently could keep the ECB from cutting by 50 basis points. There were some rumors of potentially 50 basis point cut. It might be more like 25 basis points in December, and then it could actually help the Bank of Japan increase rates in December.
Okay, so all of those people who still are annoyed by the higher prices we're facing here in the U.S. Should take solace in knowing that it's not just here in the U.S., it's happening around the world.
Unfortunately, that's right.
All right. And then, of course, there's the impact of potential tariffs that we have to think about. We heard several of the retailers discuss the possibility of having to maybe raise prices for consumers if those actually come to fruition next year. There's still a lot of uncertainty on that front. What sort of impact are you seeing from tariffs, though? Not a ton on the stock market, but in terms of the currency markets.
Yeah, that's right. We're seeing a lot of the stocks, at least on the broader market level, shrugging off these threats. The most recent one this week with 25% potential tariff on Mexican and Canadian goods. But the stocks are shrugging it off, but the currencies are really reacting. That's where we're seeing dramatic moves, and the reason is that currencies can adjust to those higher in prices that are implied by the tariffs, due to supply and demand factors. So if a tariff is placed on the import of a good, raising the price of it, the demand for the good maybe declines, and therefore the demand for the currency of that good also declines, which would offset the tariff. So to give you an example, during the trade war of 2018 to 2019, tariffs on imports from China rose 16%, but the yuan fell 14%. So that offset a lot of the tariff. So, while these potential tariffs could create some uncertainty and maybe market volatility in the near term, investors might want to take a longer term view rather than trying to trade every announcement or every social media post.
Okay. All right. I am curious. I had a guest on Morning Trade Live earlier today that said while the U.S. market exhibits bull market behavior, it's lacking global breadth. It would have a more firmer foundation if it had some more global participation. Just curious in terms of what you're seeing around the globe that could, any signs of life to kind of pass through to know if this U.S. market will have a firmer foundation.
Now, one thing I would note is that growth outside of the U.S. is outside of the U.S. and China, which are expected to decline or decelerate next year. Growth elsewhere is expected to accelerate. The IMF is expecting growth in the Eurozone to improve, for example, and that could really help benefit international equities, which are really, the sentiment is very poor. If we look at Eurozone equities, as represented by the MSCI EMU index, they're trading at a 40% discount to the S&P 500. They tend to have a discount, maybe 20% discount to the S&P 500, just due to some differences in weightings in different sectors. But a 40% discount is pretty big. And so I think the sentiment is already quite poor. And if we get any kind of good news on economic growth and just maybe people looking for value, we might see better returns for international stocks next year.
All right. Michelle Gibley, Director of International Research at Charles Schwab. Thanks so much. Always appreciate you joining us.